Treasury is selling off a bit today as the latest jobs report bolsters the case for the Fed to hold rates steady. With the labor market showing signs of gradual moderation, when can we expect to see those cuts from the Fed? Joining us now, Brian Jacobson, Annex Wealth Management's chief economist. We also have strategist Omar Aguilar. He is Schwab Asset Management CEO and CIO. Thank you both for being here with us this morning. Brian, I want to start with you. Talk to me about your read on the labor data and just how you factor that into your kind of forecast for the economy at the moment and where we're at.
Sure. Yeah. Thank you for having me. So here at Annex on our investment committee, when we were looking at the data, we really do think that it really supports the idea that the economy is resilient enough to basically skirt a recession this year. We did see some slowing in the payrolls growth earlier this week. There was a little bit more anxiety because of the content of the beige book, the ISM manufacturing and service indices, the ADP numbers. All of those are pointing to some sort of almost like kind of fissuring of the labor market, but it's not bad enough where it looks like we're going to tip into a recession. So from the big macro perspective, we think that it supports the idea that we're going to experience some slowing, but not stopping of the overall economy. And that should be a bullish indicator for earnings on a going forward basis.
Omar, I want to get your take and your read in, your recession probability and what that translates through to for portfolio strategy.
Yeah, well, the recession risks, have come down significantly since April. I think, we went at the high levels of risk probability of recession back then, mostly because of reflection of the uncertainty and the numbers that we saw in terms of potential inflation implications. I think it's interesting to see just the labor market numbers today because it does show a little bit of slowing down of the growth in the labor market. That being said, we also see a significant reduction in the size of the labor market. Just a lot of that reflecting immigration policies, that came down by around 600,000. So the overall the participation rate has come down. So what that translates into is, it probably is neutral for the Fed in terms of decision making. And what that means is, probably we're still thinking about early September as the earliest for them to do the first cut, because this labor market report, even though it does show signs of softening, it doesn't necessarily translate in potentially reduction in inflation numbers.
Brian, bringing you back in here, how does the broader sign of softening impact your investment outlook or your strategy, if at all?
Yeah, so the way that we're looking at it is you really have to think about what is the end game for tariffs, tax policy, deregulation. And back in April, a lot of people were increasing their odds of a recession for this year. Really, the market was pricing in a near certainty of a recession. But we didn't take that view because we thought the market was losing sight of what the actual end goal is likely to be. And that is probably having some baseline level of tariffs, continued tension between the U.S. and China, but not necessarily to the degree that we were seeing with those Rose Garden, with the poster board that was on there. So as a result, we were staying fairly bullish as far as looking at companies that have strong balance sheets, demonstrated profitability, but most importantly, an ability to expand those profit margins. If we're going into a period of slight economic slowing, but not a recession, I don't think it pays to be too defensive, but you don't necessarily want to get over your skis with your cyclical exposure. So we're liking financials, industrials, and technology. So kind of a nice mix of sectors that hopefully could benefit from a little bit of deregulation, maybe the market overpricing the likelihood of a recession, and then also some more attractive valuations with some of those cash cows in the tech area.
Omar, we keep hearing that there's the potential that we're going to be range bound over the course of this summer here with really just a spate of news that still could come out. So even with some of that range bound expectation, yet knowing there still could be fireworks mid-July, early July actually, coming in the form of whatever tariff negotiations net out. Also, you still have a Fed that's going to be meeting, and in June, in 2 weeks, I guess, they're going to be having their first meeting of the summer, July, and then end of the summer in September here. What, if any, in the data is going to kind of sway the markets to try to best anticipate the Fed on top of what they're reacting to in the tariff policy?
Yeah, well, it is true. I think if there is anything that we know for sure is that uncertainty will continue. And as you pointed out, markets seem to be already in a range-bound territory. We have seen both equities and bond markets just moving around the same levels, since probably the end of May and going into these first few days in June. And a lot of that is reflected even in equity market volumes, where things have not been as deeply traded as normally is, before going into the summer vacation. So investors are obviously looking at, what the implications might be of these negotiations of, after the 90-day pause and what would be the subsequent piece. The estimate is, especially just at the high level with all the research numbers, that we're going to go from a 2% tariffs that we have back in 2024 to at least 7% tariffs. And that obviously, the impact of that in terms of inflation, in terms of prices, in terms of earnings, is still unknown. And I think that goes back to the question about, what kind of data and outlooks we're going to see from companies going down the road as their potential impact on there. I think the key questions that in terms of data is consumption. At the end, our GDP growth, continues to be highly dependent on consumers. And I think the question will be how much of that consumption continues the way that we have seen it this year, and how much of that is just, that people anticipated and started doing the consumption early on in anticipation of the potential impact into the economy for tariffs.